Hello, everyone. This is Dr. Mahmoud Al-Odeh, and here we have a new chapter for TEDT 3267, Cost Estimating and Break-Even Analysis. So in this chapter, once we finish this chapter, you will be able to calculate the fixed, variable, marginal, and average cost of alternatives. So we will learn in this chapter about these different types of cost: fixed, variable, marginal, and average cost for different alternatives. Number two, as objectives for this chapter, we will be able to develop equations for total cost and total revenue. Number three, we will be able to calculate the break-even points for similar projects. Number four, identify opportunity costs for alternatives. Number five, use these techniques, and I'm going to list them down for you: unit cost method, price index, power sizing model to estimate the cost of alternatives. Number six, we will be able to use the learning curve strategy to estimate cost and predict performance of your employees. Number seven, and the last objective for this chapter, is of course utilizing Excel spreadsheet to conduct several cost estimating analysis that we will discuss in this chapter. As an introduction, this chapter you will be learning several techniques, several costing techniques that will help you to analyze and estimate cost, or even forecast the revenue for specific projects. Many different cost categories are employed in the evaluation of alternatives. Some of these costs would be initial investment, cost of new construction, cost of facility modifications, general labor, parts, and material cost, and overhead cost. In order to get into more details and to be more specific, we will be talking about these four types of cost. Number one is the fixed cost, and this is when we say fixed cost, this cost is unchanging and it's constant cost regardless of the output capacity. Example of a fixed cost would be building rental costs, so the rent that you pay for a building or your apartment. That's a fixed cost. You have to pay it every month. Insurance bills, this is another things that we consider as a fixed cost. Utility bill, also this could be considered as a fixed cost. The number two types of cost would be the variable cost, and these costs are changing based on the output, based on the capacity of your project. Example of a variable cost would include material cost, labor cost, and maybe advertisement. So the more you advertise, the more money that you'll pay. The total cost. Okay, so now if we need to talk about the total cost calculated by adding the fixed cost plus the variable cost, and we use this equation, total cost equal fixed cost plus the variable cost, and the variable cost will depend on the unit. So fixed cost plus the cost per unit times the number of units. And if we look into this chart will demonstrate the difference between the fixed cost and the variable cost. So in the orange line right there, you will see the fixed cost. It's a constant over the time, over the quantities. No matter what the quantities or the outcome is still constant. The variable cost in gray, as you see, increasing with the number of units that you're producing or the project that you're serving. So it is increasing with the output capacity for your project. Total cost is adding these together, and that will be considered in this yellow line right there, increasing with the number of output or units that you're producing, based on the variable cost. The other two costs that we will be talking about it is the marginal cost, and the marginal cost is changes in total cost by increase or decrease as a result of adding one more unit. So let's give you this example that will help you to understand what is the marginal cost. For example, 4 people can fit in a taxi that costs $50. So, just 4 people could fit in a taxi and you have to pay $50 for the taxi driver. Now, if we need to add one more person, that would not fit in the taxi. So that would result in adding another $50 because, there is a need for another taxi to put the 5th person. So that's what we call the marginal cost. The marginal cost is the total cost by adding one more unit. Now for the average cost would be the total cost divided by the number of units. So for example, if we have 50 units and these 50 units cost $100, the average cost would be dividing the $100 by 50 units. That would give you $2 per unit. And we use this equation to calculate the average cost. The average cost would be fixed cost divided by the number of units plus the variable cost. Another example to clarify the difference between marginal cost and the average cost is the tuition system that used in most universities in the USA. For example, Bemidji State University student who registered for 12 to 18 credits will be charged a fixed amount of money. That's a fixed cost. If a student registered for credit hours over the 18 in a given semester, that will result in adding additional charges should be applied. The marginal cost in the adding one more unit, that would be just, the marginal cost, adding one more unit on the top of the 18, that would be considered as a marginal cost. The average cost per credit will be the total cost divided by the total credits per hour. All right, we'll take an example to verify this and clarify this concept, but we need to finish with two more costs that we need to discuss it here. The sunk cost. The sunk costs are costs that have already been accounted for and are lost without adding any value or any benefits for the business. Therefore, should not be considered in future decisions. Here's an example for you to understand what is the sunk cost. The sunk cost would be building a new house, for example. If you want to build a new house in an existing neighborhood, that might cost you $200,000. But in order to build that house, that will require from you to demolish the old house that is already there for $20,000. So this $20,000 cost for demolishing the old house will not increase the value of the new house. Therefore, the $20,000 is considered as a sunk cost for this project and should not be considered into the future decisions. Now, the last cost that we need to talk about it here in this chapter, and then we will start applying what we've learned in the different examples. This is what called the opportunity cost. The opportunity cost is the loss of potential earning that could have been gained if a decision was made to pursue a foregone opportunity. But because of making a different decision, these earnings were never received. Here is an example for you. A simple example of opportunity cost: if a student is traveling abroad to another country during the summertime, if the student had stayed during the summer and worked during the summer, these 3 months, for example, he or she might receive and gain $10,000 because of the work over the 3 months. But however, because the decision for that student made to be traveling abroad, so this $10,000 is considered as an opportunity cost. And sometimes we need to consider some of these opportunity costs in different decisions. All right, let's take a look into these examples. Example one, we have Jeff, who's in operations management program. His school charged a fixed cost of $4,500 for any students who register 12 to 18 credits. Now, what I want from you, I want you to calculate the average cost per credit if Jeff registered for 12 credits, for 15 credits, and for 18 credits. And number 2 of this example, or part B of this example, I want you to find the marginal cost if Jeff registered for 12 credits and would like to increase his load to 15 credits. Part 2 of part B, I want you to calculate the marginal cost if Jeff registered for 18 credits and would like to increase his load to 21 credits. All right, let's start with the first part, part A. As you see here, the average cost per credit, if Jeff registered for 12 credits, that would be the total cost, which is $4,500 divided by 12 credits. And that will give you $375 per credit. And now if Jeff registered for 15 credits, that would be the total cost 4,500 divided by 15 credits. That will give him as an average cost to be $300 per credit. Now for 18 credits, that would be the average cost would be divided the total cost, which is 4,500 divided by 18 credits. And that will give you $250 per credit hour. Now let's take a look into part B and the marginal cost. The marginal cost, if Jeff registered for 12 credits and would like to add one course of 3 credits course. So since 15 credits is still within the 18 credits range, the marginal cost is 0. So adding 3 more credits is not going to add anything on the top of the 4,500. So still the marginal cost would be 0. Now, if he registered for 18 credits, but he would like to increase it to 21 credits, the marginal cost for adding 1 more credits is 4,500 divided by 12. That's the average. As you see, we calculated that in part A, 375 per credit. And the cost for 21 credits would be the 4,500 that we will receive plus the 3 credits times 375, and that will give you a total of $5,625. Now that's for the total cost for registering 12 credits. Now, of course, we could use Excel for that. Now, if you want to use Excel, you could use it, but there's not a particular function that we will use. We will be using Excel as a calculator, basically, doing the divisions and the multiplication. It's easier for you, actually, instead of having a calculator. Using Excel, now you are used to using Excel, so it should be fine for you to use Excel. So for example, if I want to try this using Excel, so I'm going to switch to Excel here in just a second. All right, so we have this example number 1. All right, here we go. So if we need to use Excel, we could, so we have a fixed cost for 4,500 if a student registered between 12 to 18 credits. The average cost would be 4,500 divided by 12, and that's 375. That's for if registered for 15 credits, you divide the total cost by 15, that will give you 300. And if you want to find the average cost if the student registered for 18 credits, you divide the 4,500 by 18, that will give you 250. Now, for the marginal cost, we agreed that if increase the load from 12 to 15, it's not going to add anything. So the marginal cost is 0. Now, if Jeff is starting to increase his load from 18 to 21, then we have to find out what would be the cost. So what would be the cost? Average cost would be, as we calculated there in part A, which is 4,500 divided by 12, that will give you 375. And the cost for 3 credits would be 3 times 375. And now you add the 1125 to the 4,500 to get the total cost to be 5,625. All right, so I hope this is helpful. Now we're going to continue on the chapter, and we will take a look into example 2. We will take a look at it, but before we do that, we have to talk about the cost volume analysis. The cost volume analysis would be, it's a great technique that we use as a manager to calculate revenue, profit, or losses. Revenue is income that the company gains from its business activities, such as sales of product, performance service, or revenue gained from interest rate charges, basically, or fees on investment income. All right, so if we need to calculate the revenue, we multiply the number of units times the sales per unit, the price per unit, how much they sold. So if, for example, if you sell laptops and each laptop will cost 500, if you sold 10 laptops, that would generate a revenue of $5,000. 500 times 10, that would give you 5,000. The profit now, the profit is the net income of revenue minus the total business expenses in a given period. So for example, if we need to write these in equation, we say profit is equal to the total revenue minus the total cost. And remember, the total cost is the fixed cost plus the variable cost. If the total cost, of course, this is if we know, are we making money or losing money? We need to compare the revenue versus the cost. If the total costs are higher than the total revenue, this would result in a cost. Here's an example for you that I want you to try. XYZ, a small company that cleans boats in northern Michigan. The company expenses are as the following. So rental is $50,000. One employee salary is $60,000 per year. Utility bill is $20,000 per year, and material is $500 per project. The company charges $1,000 per cleaning project. Calculate the net profit or lose that the company are making or losing if they worked 250 projects last year. All right, so what we need to do, we will write down the total cost. First of all, we need to find out what would be the total cost. The total cost would be the fixed cost plus the variable cost, 50,000 plus 60,000 plus the 20,000 plus the 500 times 250 project. That will give you 255,000 as a total cost. Now we need to find out the total revenue. The total revenue would be the number of projects times the price charged per project. And we have 250 projects based on last year forecasting or based on last year history. We multiply it by $1,000. This is what they charge per project. That will generate a revenue of 250,000. And in order to find the net profit, the net profit will be equal to the total revenue minus the total cost, 250 minus 255, and that would result in a $5,000 in loss. As you see, it's a negative number right there. So which means the cost is higher than the revenue. So basically, they're losing $5,000 if they have a 250 project only. Now, what we need to do, we could use Excel, of course, as we did here. I have a screenshot of my Excel provided for you here. I want you to try it on your own, and then let me know if you have any question of using Excel, but that will should give you the same result of negative $5,000 as a net loss for that particular project. All right, I'm going to end the video here, and then for the next video, I will be talking about the break-even analysis. So I hope this is helpful. Please let me know if you have any question. Thank you.